In this presentation, we're going to record an advanced payment from a customer. In other words, we have a guitar that we're going to sell. The guitar is not currently on hand. The customer is committing to it and therefore giving us a deposit to commit to the sale. Once we then get the guitar, we will complete the transaction. Here we go with Xero. Here we are in our Get Great Guitars dashboard. We're going to be starting off by opening up our income statement and our balance sheet this time. It's a new kind of transaction. Let's open them both up. We're going to go to the accounting dropdown, open up the balance sheet. When that opens up, we're going to duplicate the tab by going on up to the tab up top, right-clicking on it. We'll duplicate that tab. Then I'm going to go back up to the balance sheet, and we're going to open up the income statement, not to the balance sheet. I'm going to the first tab, which says balance sheet, but we're going to be changing the name here. It's going to be going to the accounting drop down to the income statement, and then we're going to duplicate that tab by going up to the tab on the top, right-clicking, and duplicate that tab. Then I'm going to go back to the balance sheet. We'll adjust the date. The date's going to be for February, so we'll bring this on out to February here, February 29th. That's what we want. Update that report. Then I'm going to go back to QuickBooks Desktop just to look at the flow chart here. There's a little bit unusual type of flow. So what's happening normally when we have a sale, usually either we do the work first and then we invoice the client for the work that we have done and then receive payment on it. Or we do the work at the same time and basically give a sales receipt at the check register as we've seen in the past. However, in some industries and in some cases, we have a system where the customer pays us first. And then we basically, do the work at a later point in time. Well, that's kind of unusual. When would that happen? This is all the same kind of thing. So it could happen on industries or a certain kind of transaction within a particular industry. For example, if you deal with an industry that's a subscription-based industry, you often get paid first. Newspapers were the classic example. If you have magazine sales, those were the classic example where people got paid before they delivered the magazines, and therefore they shouldn't really be recording revenue at the point in time they got paid because they haven't done any work yet. They might have a year's subscription and they haven't done anything. They got paid before they do anything. Or if you have online stuff now with subscriptions, a lot of big things are in subscriptions these days in terms of software. So you could get software beforehand and you're paying for the use of the software. Same kind of idea. You'd get paid before you do the work, which is a little bit unusual. That's unusual with comparison to most industries where you do the work first, then get paid, or at the same point in time. Any industry where you have an event, that's typically the same thing. If you're gonna have a concert, you get paid before you have the concert. Typically, they gotta buy the tickets first, and then you have the concert. So you're getting paid before you do the work. Now, then in particular industries, this could happen in some cases as well. For example, if you're a rental company, you might require a down payment, basically, or a deposit. And that's a similar kind of thing. You're getting money for something that you haven't earned it. So you're going to have to record it in a similar type of way, like unearned revenue or a deposit. Or in our case, we have someone committing to a purchase in the future that we haven't yet made yet. So in our case, an example, if we have a big purchase like a guitar or something like us, someone comes into the store, they say, hey, I'd like to purchase a guitar. We're going to show them all the guitars we have. And we say, hey, we don't have that particular guitar on us. However, we will order it for you if you commit to the purchase. How can we commit to the purchase? You can give us a down payment. So you give us a down payment now, we'll order the guitar. When we get the guitar, then we'll give it to you and we'll complete the process. So what happens is we get paid before we issue the invoice, in this case, which is a reversed order. Now, so when this reverse type of thing happens, we got to think about, well, how are we going to do that with the forms? Now, typically when you have the receive payment, what happens is it decreases accounts receivable, and then the other side's going to go into cash in some way, shape, or form. But we don't have the receivable hasn't increased yet, so to do that would result in a negative receivable, which sometimes in some software, that's basically what we do. We create a negative receivable, and then we can reverse it. Well, actually, that's kind of like a workaround that we'll often do in many types of software, and it works quite well. It's easy to do, but it's not exactly proper with regards to the normal transaction that we have learned. Normally, you would want to put it into a liability account. The reason it works okay is because you could still do an adjusting entry at the end of the period, and what you're trying to do when you do that is be able to track the prepayments in the same kind of area, the same sub-reports that you would create for accounts receivable. The accounts receivable ties to the customers, so if you got a prepayment for a customer, it would make sense to kind of work that into the accounts receivable so that you can then track that accounts receivable with the customer data, even though it's a prepayment. However, Xero has a really nice system to kind of allow us to still apply the prepayment to the invoice we'll create later and create kind of the correct transaction, which is to create a liability as we go, which is a pretty neat system. Let's check it out. We're going to say someone came in and put a down payment on a guitar that we're going to complete the transaction later. So we're going to have a receipt of money. We got money at this point in time. However, we have not yet earned it with revenue because we haven't completed the transaction. We haven't done the service or given a guitar. We're going to put this into the clearing account, as is our typical practice. So we're going to put it into our clearing account and say next. And now within the new received money, rather than a direct payment, we're going to take this down to a prepayment. So we're going to make this a prepayment. The customer is going to be Anderson. So we're going to put Anderson Guitars. The date is going to be February 16th. And then we're going to go down to the description. So within the description, we're going to say this is going to be a prepayment or a deposit, and it's going to be for $250. Now they have a nice system here that allows us actually to put it into a liability account, which is the proper thing to do, and still be able to connect that through this prepayment kind of selection to the invoice that we'll make later. So what I'm going to do is I'm going to set up another account. I want to set up a liability account. If I go on down here, something like a deposit or unearned revenue or something like that. So it's going to be in the liabilities section. I don't see anything here for what I'm looking for. So let's put it somewhere under the sales tax line. So let's put it on 222210. 2210. That's going to be the account number, the 2210. We're then going to say the account type is going to be a current liability. So it's going to be on down here in the liability. We'll make it a current liability. I'm going to call it unearned revenue. Some people like deposit, whatever resonates with you, but unearned revenue is what I learned in my accounting schools and whatnot. So that's what's stuck in my head. So there's the 250. What's this going to do when we record it then? It's going to be increasing the checking account because it's a received payment. It's going to then be increasing the liability of the unearned revenue rather than going to a revenue account for the deposit that we're receiving from the customer. And we have that nice connection still so that when we create the invoice later on, we should be able to pull this out automatically from this credited amount, which is really pretty neat. So we're going to say save here and see what happens. Save on that. And see if I messed anything up. It looks like it's been recorded properly. Let's go on over to the balance sheet now and update the balance sheet. So what we have here, and what we have is an increase to the clearing account of the 250 as we would expect. So that is going up. The other side then is going to, if we scroll on down, it's going to be going to the unearned revenue. So it's a liability now until we get the guitar. We haven't earned it yet. It's not on the revenue. Therefore, no effect on the income statement. If we went over to the income statement, nothing has happened there, because all we did was increase the liability on the balance sheet until we actually complete the transaction. We will complete the transaction jumping over to our flow chart. When we then create an invoice later on, we'll create an invoice and attach this, apply this out to it, this prepayment at that point in time. Now we're going to go back on over to the first tab and go into our dashboard, and just let's consider where this will show up in terms of tracking this information. I'm going down to 100% once again. I'm going to go into the invoices owed to you, and then within this section I want to go to the see all. So I want to say see all. And you'll notice up top, we haven't created an invoice yet, right? We created the payment, but we have this nice little item up here which says a PP. That little PP means there's a prepayment. So we have a payment, there's an amount paid that we expect to apply out to an invoice. It's ready, in other words, to be applied out to an invoice. So when you see that little PP, that's what it means. And when you create an invoice, the next invoice we create for Anderson will then give us hopefully a little pop-up as we create the invoice and say, hey, there's a prepayment. Would you like us to apply out this prepayment to this invoice? Which, of course, typically we would want to do in our normal flow of things. So next time, that's what's going to happen. We started here and we made that, the deposit. Next time, we're going to go backwards, basically entering that invoice, applying out this deposit to it. That deposit now showing here as the little PP item. That's it for now. Let's go to the beach.